Hey everyone, and welcome to The Explainer. Today we are diving straight into something that is absolutely fundamental for anyone looking to grow their wealth securely. We're going to break down the actual mechanics of investment risk. We'll be looking at how investment funds operate, not just as profit vehicles, but as a literal risk shield for your money.
Okay, so I want you to picture a truly terrifying scenario for a second. What happens to your money if the one and only company you invested in completely collapses? The source text gives us this great historical example, Marconi. If you had taken every single cent of your life savings and poured it into a single equity, like Marconi, and it goes under, poof, your money completely vanishes. You suffer a total capital loss. It's the absolute ultimate danger of putting all your eggs in one basket.
So, to figure out how to avoid that exact nightmare, here is our roadmap for today. 1. The investment fund concept. 2. How funds spread risk. 3. Active versus passive management. 4. Measuring risk and performance. And finally, 5. Costs and remaining risks. Let's get right into it.
Section 1. The investment fund concept.
Basically, an investment fund is just a way for you to invest your money alongside a whole bunch of other people. And the crucial takeaway here is that the primary goal actually isn't just chasing astronomical returns, it's risk reduction through collective power. By teaming up, investors unlock these inherent advantages that a single person trading alone in their living room simply can't access. It is all about teamwork, protecting your capital. I really love this metaphor from the source material. It actually stems from the old Greek markets. Think of a mutual fund as the common cashier of many investors. You, me, and thousands of other people all trust a third party to manage our pooled wealth. We hand our cash over to this common cashier, and they go out and buy a massive, highly diverse array of financial products on behalf of all of us. It just makes the whole concept of pooling money instantly relatable, right? Now, behind the scenes, these funds usually take one of two main structures, open-end or closed-end, and it's super important to know the difference. With an open-end fund, the fund is divided into shares, and their price varies in direct proportion to the fund's net asset value. It's fluid. Every time someone invests, new shares are created, and when they cash out, assets are sold. But closed-end funds? Totally different beast. They issue a fixed, limited number of shares through an initial public offering, and then those shares are traded on a secondary market, like a stock exchange. Because of supply and demand, you might end up buying those shares at a premium above their actual net asset value, or you might snag them at a discount.
Moving on to Section 2. How funds spread risk.
This entire concept boils down to one absolute unbreakable investment principle. The more diversified your capital, the lower the capital risk. We call this spreading risk. If you think back to that Marconi disaster from earlier, spreading risk is literally the antidote. By investing in a huge range of individual securities, a total catastrophic loss is pretty much prevented. If one single equity tanks, well, it's just a tiny little drop in the overall pool.
But listen, it's not just about blindly hoarding a bunch of random stocks. Take a portfolio split evenly right down the middle, 50% equities, 50% fixed income. Our source points out that if all your investments are tied up in the same asset class or market sector, you face what's called systematic risk. That means a bad day for that specific market brings your entire portfolio down with it. To dodge that, professional managers diversify into non-perfectly correlated assets. So if the stock market takes a nosedive, that fixed income portion acts like an anchor to shield your capital.
And the perks of this collective investing approach go way beyond just spreading risk. First off, you get the heavy hitters, access to professional investment managers who literally dedicate their lives to this research. Secondly, the economies of scale are just unbelievable. I mean, if you or I tried to individually buy hundreds of different stocks to build a perfectly diversified portfolio, the transaction costs alone would eat us alive. Buying as a massive group drastically lowers those dealing costs. Plus, you totally eliminate the need to spend all your free time analyzing earnings reports.
All right, Section 3. Active versus passive management.
So how do managers actually choose to invest this giant pool of cash? It usually comes down to a really sharp philosophical contrast. Actively trying to beat the market versus passively copying it. Active management means a manager is in there dynamically buying and selling securities based on changing market conditions. They want to outperform the market. Passive management, on the other hand, means sticking to a very strict, fixed strategy, like an index fund, that just replicates the performance of a market index. They aren't trying to beat the market, they're just trying to keep the ongoing costs as low as possible.
Now, you might be thinking, does active management ever actually win? Well, check out this fun anecdote from the source text. Back in 1998, Richard Branson, the head of Virgin, made a very public bet with Nicola Horlick. He bet her that her actively managed SG UK Growth Fund wouldn't be able to beat his passive Virgin Index Tracker Fund over a 3-year period. And guess what? He lost. Her active management successfully outsmarted the index tracker, and Branson had to pay a £6,000 bet to charity. So yeah, for sure, active managers can sometimes add real tangible value over a passive strategy.
Which brings us to Section 4, Measuring Risk and Performance.
Okay, so how you know if your fund is actually doing a good job? Let's translate some of these intimidating statistical terms into plain English. Think of this as your fund manager's report card. First up is alpha. This represents the fund's return when the benchmark's return is 0. Basically, it's the direct value added by the fund manager, so higher alpha means a better manager. Next is beta, which estimates how much the fund will move if the market moves by 1 unit. It shows how sensitive your fund is to market swings. Then we have R squared. This measures correlation to the benchmark on a scale of 0 to 1. This one is super important because it tells you if your highly paid active manager is actually just acting as a closet tracker. You know, secretly mirroring the market while charging you those premium active fees. Finally, standard deviation. This measures historical volatility. A higher figure means greater variability, which points to increased future investment risk.
Finally, Section 5, Costs and Remaining Risks. As amazing as these risk shields are, there are definitely trade-offs to the collective approach. First and foremost, nothing is free. You have the annual management charge and other administrative fees eating into your assets. You're paying for that expertise. Secondly, you really suffer a lack of choice. You can pick the overall fund, sure, but you have absolutely zero control over the specific individual stocks inside of it. And lastly, you lose your direct voting rights. If you owned a stock directly, you could show up and vote at the company's annual general meeting. Inside a fund, you surrender that voice entirely.
And listen, we have to be real here. The source explicitly warns that a truly risk-free investment just does not exist. Even with the absolute best managers and textbook diversification, external risks are always lurking. You still face capital risk, which is that baseline fear of losing the money you invested. Then there's currency risk. If your fund holds foreign assets, simple everyday exchange rate movements can negatively hit your bottom line. And finally, liquidity risk. If the fund invests in stuff that isn't easily sold on the open market, like maybe commercial property, you might find yourself unable to sell quickly when you desperately need your cash.
So after everything we've unpacked today, the spreading of risk, the heavy fees, the performance metrics, we are left with this incredible multi-trillion-dollar question. Can professional, active investment managers reliably enhance your returns by an amount that actually exceeds their hefty fees and expenses? Or, considering the inherent risks of the market, are you ultimately just better off passively tracking the index? It's a massive debate, and it's exactly what our source leaves us pondering today. Thank you so much for joining me for this explainer on the mechanics of investment funds. Keep asking those great questions, and I'll catch you next time.